Hello, and you're welcome to Global Business Insights, where we look at headlines from a deeper business perspective. UK Prime Minister Keir Starmer is in Washington, where he will hold talks with President Joe Biden today on whether to allow Ukraine to use Western-made weapons for strikes deep inside Russia. Vladimir Putin says that could result in war with NATO nations. The European Central Bank cut interest rates again yesterday, also signaling a path of following borrowing costs in the months ahead as inflation slows and Eurozone economic growth remains still tepid. How will easing of monetary policy in Western economies affect emerging markets, especially Africa? That will be our deep dive. The US Fed also expected to cut rates next week. An interest rate cut from the Bank of England next week looks unlikely, but investors will be watching for clues about future moves. European markets opened higher this morning after the announcement of the ECB rate cut yesterday. Former President Trump has ruled out another presidential debate against Kamala Harris. 2 days after the last ABC debate, Harris replied that we owe it to the voters to have another debate because of what is at stake. And the latest polls give Harris a strong edge, especially helped by the consensus view that she outperformed Trump in a debate that all agreed was perhaps lacking in substance on the issues important to undecided voters, especially the economy. Yesterday, Trump promised to exempt overtime pay from taxes as the race heats up. The US House has approved a bipartisan package of bills to counter China's influence and ensure America comes out ahead in the competition between the world's superpowers. This includes banning Chinese-made drones, limiting China-linked biotech companies from access to the US market, and strengthening various sanctions while deepening ties with other Asian countries. US citizens that newly applied for unemployment benefits reached 230,000 in the week ending September 7. The print matched initial consensus and slightly higher than the previous weekly figure of 228,000. That was revised from 227,000. Still in the US, wholesale prices, that is producer price index, yesterday rose 0.2% in August and 1.7% year on year, broadly in line with expectations. Also, US stocks jumped yesterday as investors weighed fresh inflation and labor data ahead of almost a certain quarter point interest rate cut next week. The Nasdaq Composite up around 1% led gains, the fourth straight positive day, fueled by a revival of technology stocks. Oil prices spiked back up with Brent over $72 from a sub $70 a barrel price earlier in the week. This was as Hurricane Francine, now downgraded to a tropical storm, affected output in the U.S. Gulf of Mexico, disrupting up to 1.5 million barrels of U.S. crude production. The South African Reserve Bank is expected to cut its repo rate by 25 basis points to 8% at its September 19 meeting. Inflation rate was down for the second month to 4.6% in July 2024, down from 5.1% in the prior month and edging closer to the preferred target of 4 to 5%, 4.5%. That's the SARB target. The drop in inflation opens the door to easier policy for the first time since its COVID-19 response over 4 years ago. And in Nigeria, the National Bureau of Statistics new report on country's trade balance showed it recorded another trade surplus in the second quarter of 2024, hitting 6.95 trillion naira, also higher than the 6.52 trillion surplus recorded in Q1. The European Central Bank yesterday delivered a second quarter point interest rate cut this year. This was as a combination of sluggish growth and cooling inflation led to cutting again as markets looked for fresh clues as to what will follow. Here's a clip from Lagarde's speech at the press conference after the decision.
The Governing Council today decided to lower the deposit facility rate, the rate through which we steer the monetary policy stance, by 25 basis points. Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, it is now appropriate to take another step in moderating the degree of monetary policy restriction. Recent inflation data have come in broadly as expected, and the latest ECB staff projections confirm the previous inflation outlook. Staff see headline inflation averaging 2.5% in 24, 2.2% in 25, and 1.9% in 26. As in the June projections. Inflation is expected to rise again in the latter part of this year, partly because previous sharp falls in energy prices will drop out of the annual rates. Inflation should then decline towards our target over the second half of next year. For core inflation, the projections for 24 and 25 have been revised up slightly as services inflation has been higher than expected. At the same time, staff continue to expect a rapid decline in core inflation from 2.9% this year to 2.3% in 25 and 2% in 26.
The European Central Bank will not pre-commit to a particular interest rate path over the coming months, but investors expect further monetary policy easing through to the end of the year. But for now, analysts are split on if the ECB will pause at next October 17th meeting as they did in July and maybe delivering the next cut on December 12th. The US Fed appears ready to start its own rate cutting cycle next week. As expected, Lagarde was asked about justification for the decision yesterday and future rate cuts. This is what she said.
When I said that we looked at all the information that we get on the occasion of a projection exercise through our three prisms, I'm referring obviously to the inflation outlook, I'm referring to the underlying inflation, and I'm referring to the transmission of monetary policy. And, you know, on the inflation outlook, when we receive the projections of our staff for September, it's virtually unchanged relative to June for the inflation outlook. And it continues to see a return to 2% before the end of 25. And this is, by the way, the 5 consecutive projection exercise pointing to that 2% at the end of 25. So why do I say that? Because it certainly reinforces our confidence in the solidity and robustness of those projections. That's for the first prism, the inflation outlook. The underlying inflation, on the other hand, we look at the various indicators that we have, from domestic to PCCI, and here we see one particular indicator, the domestic indicator, which is abating a little bit because it moved from 4.5 to 4.4 between June and July, and it is not satisfactory. It is resistant, it is persistent. This is the reason why we have to be resilient in our approach and very attentive to the various components. Well, future, I'm tempted to quote, Spanish, que será, será, because we have consistently said, and we repeat again, that we shall remain data dependent, and that is particularly justified in view of the uncertainty that abounds. So we shall be data dependent. We shall decide meeting by meeting, and our path of which the direction is pretty obvious, a declining path, is not predetermined, neither in terms of sequence nor in terms of volume. And I would like to add one thing which I have already said before, which is still true, which is that data dependency does not mean data point dependency. We're not going to be fixated on one single number. We are looking at a whole battery of indicators. And I'm saying that in particular because September will certainly deliver a low reading of inflation, very likely. We expect, because of the base effect, particularly on energy, our inflation numbers to be up in the fourth quarter, so the last 3 months of 24, but September is going to deliver a low reading. But we're not just looking at one indicator. We're looking at a whole range of data that we receive.
As Western economies cut rates, the monetary climate all over the world will see some relief. According to a recent report by the IMF, the era of tightening resulted in a sharp slowdown of Eurobond net issuance by emerging market and developing economies, down 70% relative to the prior 2 years. Also, the tightening led to net Eurobond outflows totaling about $58 billion due to maturing Eurobonds exceeding abating new issuance. As rates become more affordable for net borrowers, there is already a recovery in Eurobond issuance to the tune of about $40 billion in the first quarter of 2024, as countries such as Benin and Côte d'Ivoire return to the market. The onset of a Fed easing cycle supports an additional rebound in Eurobond issuance and a broader revival of capital flows to emerging markets and developing economies, and of course increased dollar-denominated debt volumes. Lower interest rates create the opportunity for debt-burdened EM, that's emerging markets, to refinance more expensive borrowings to reduce their debt servicing costs. As appetite for EM assets is revived and capital flows back, it's an opportunity for Africa to strategize afresh, not misusing this opportunity by ushering a new phase of profligacy. Priority should be given to technology infrastructure, education and health, on getting the basics right and repairing foundations. Both recurrent and capital expenditures have to be comprehensively re-examined. New paradigms for governance are needed to get better value and improved productivity. We should have learned from the tough era of tightening what we really do not need and what we must have. We just saw a stampede into Nigeria's first local dollar bond, massively oversubscribed. Access to foreign capital is less the issue. The bigger challenge has always been judicious spending, discipline, and project conceptualization and plugging leakages, reviving productivity by cutting waste and killing the monster of corruption. And China has approved a plan that will raise the retirement age for the first time since 1978. China will increase the retirement age for men from 60 to 63 and for women from 50 and 55 to 55 and 58. This change will take place over 15 years starting 1st January 2025. More headaches for Boeing. Boeing's US West Coast factory workers will walk off the job after 96% voted yesterday in favor of a strike. This stops production of the plane maker's strongest selling jet as it wrestles with chronic output delays and mounting debt. The workers' first strike since 2008 starts today, weeks after CEO Kelly Ottberg was brought in to restore faith in the plane maker after a door panel blew off a near-new 737 MAX jet in mid-air. That was in January. Asia-Pacific markets were mixed as mainland Chinese markets rebounded from a 6-year low and Australian markets were near an all-time high. Japan's Nikkei gave up previous gains as the yen strengthened on hawkish signals coming from the Bank of Japan, pressuring equities. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Again, thank you so very much for watching. Bye-bye.